Welcome back to Money Moves, your one-stop shop for all things money. We're talking making it, managing it, and yes, even multiplying it. Today we're strapping in for a deep dive into the world of day trading.
That's right. We're talking about turning those pennies into profits, all in the space of a single trading day. But before you quit your day job, let's break down what it takes to build a winning day trading strategy.
Okay, so let's say someone like me, hypothetically, wants to dip their toes into this whole day trading thing. Where do we even begin? Feels like there's a million different directions you could go.
You're right. It can feel overwhelming at first. That's why the very first step is crucial, understanding the playing field. And I'm not just talking about knowing the difference between, say, stocks and crypto, though that's obviously important. It's about the personality of each market.
Personality. Like forex is the life of the party and bonds are the quiet kid in the corner.
I like the way you think. But seriously, each market has its own rhythm. When's it most active? How much do prices swing around? A strategy that thrives in the nonstop action of forex, where those price swings can be tiny but frequent, might completely flop when Wall Street closes and things quiet down.
So it's like choosing the right dance floor for your style. You don't want to be doing the tango at a techno rave.
Exactly. You've got to match your approach to the market's energy. And once you've found your market, you've got to pick your lane within it. Day traders rarely spread themselves thin. They become experts on one stock, one currency pair. You name it.
Instead of being a jack of all trades, you're mastering one. Makes sense. Deeper knowledge, more confidence in your moves. Like, I wouldn't try to become a master chef overnight, but maybe I could conquer the perfect souffle.
Now you're getting it. But before you even think about whipping up that souffle, we need to talk about something a little less glamorous, but absolutely essential. Risk management.
I knew you were going to say that. But seriously, everyone says risk management is important. What does it actually mean for a day trader, someone making dozens of trades in a day?
It's about being smart, not scared. It's about having a plan for every trade, even before you hit that buy button. And a key part of that is understanding something called the risk-reward ratio.
Okay, break that down for me. I'm all about minimizing risk, especially when my hard-earned cash is on the line.
It's all about determining how much you're willing to lose for the potential to make a certain profit. So, for example, a 3.1 reward ratio means you only risk $1 for every $3 you're aiming to make.
So I'm basically saying I'm willing to bet $1 to potentially win 3. It's like setting a limit at the casino, knowing when to walk away whether you're up or down.
Exactly. It's about protecting yourself from those inevitable losing streaks that every trader experiences. And another key aspect of risk management is position sizing.
Position sizing. That sounds a little technical. Is this where we need a dictionary of trading terms?
Not at all. It's actually quite simple. Position sizing refers to how much of your capital you're putting into each individual trade.
Okay, so like not putting all your eggs in one basket, even if you're feeling super confident.
Precisely. It's like diversifying your portfolio, but on a smaller scale. You never want to put yourself in a position where one bad trade wipes out a huge chunk of your capital.
So even if a trade looks like a sure thing, and let's be honest, there's no such thing. You don't want to go all in. You've got to leave room to navigate the unexpected twists and turns of the market.
Exactly. It's about playing the long game and protecting your capital so you can continue trading day after day.
It's like they say you got to stay in the game to win the game.
Now, once you've got a handle on the risk side of the equation, and trust me, that part's crucial, then comes the fun part.
Don't tell me. It's picking the perfect day trading strategy right. I've heard there are more trading strategies than there are flavors of ice cream.
You're not wrong. There's a whole buffet of tactics out there, each with its own flavor and approach. We've got scalping, trend following, counter trend trading, breakout trading. The list goes on.
Whoa, slow down. Let's unpack these one by one, starting with scalping. What's that all about?
Picture this. You're making a dozen trades in the time it takes to drink your coffee. That's the life of a scalper. They're all about lightning-fast trades, exploiting those tiny price fluctuations that happen in seconds, not minutes.
Sounds intense, like you'd need nerds of steel and maybe an industrial-strength coffee maker. What about trend following? That sounds a bit more my speed.
It's definitely a popular approach, and for good reason. It's all about identifying the prevailing direction of an asset's price movement. Is it going up or is it going down? And then riding that wave, so to speak.
So if I see a stock on a roll, I hop on board and try to ride it for as long as it climbs.
You get the basic idea, but of course it's a little more nuanced than that. Trend followers use all sorts of tools and indicators to identify those trends and determine when to enter and exit trades.
So it's like charting the tides before you set sail, making sure the currents are in your favor.
Now that is a visual I can get behind. And speaking of tools, one of the most common ones trend followers use is moving averages. They're basically lines on a chart that smooth out price fluctuations to reveal the underlying trend.
Sounds helpful. But how do you even choose the right moving average? I mean, there must be a million different variations.
You're right, there are lots of different time frames you can use, and each one tells a slightly different story. A common one is the 50-day moving average, which averages the closing prices of the last 50 trading days. It gives you a broader view of the trend.
So a longer time frame like that helps you smooth out the noise and see the bigger picture. But what about for shorter-term trends?
That's where a shorter moving average comes in, like a 20-day moving average. This one is more sensitive to recent price changes, making it a favorite for traders who are looking for quicker trades.
Got it. So if I'm feeling adventurous and want to ride those short-term waves, the 20-day is my go-to. But if I'm playing it a bit safer and looking for a longer-term trend, the 50-day is a good bet.
Exactly. It's all about finding what works best for your trading style and risk tolerance. But remember, no matter what kind of trend you're following, you always need a solid risk management plan.
Right, because even the smoothest sail can hit choppy waters.
And speaking of choppy waters, that brings us to our next day trading strategy, counter-trend trading.
This sounds a bit like swimming against the tide. Why would anyone want to do that?
Because sometimes going against the grain can be incredibly profitable. Counter-trend traders, as the name suggests, try to profit from short-term price swings that go against the prevailing trend. They're essentially looking for those moments when an asset is overbought or oversold.
So it's like those contrarian investors who buy when everyone else is selling and vice versa.
You got it. They're looking for those moments when the market might be overreacting, and they're ready to pounce when everyone else is running for the hills.
I can see how that could be profitable, but it also sounds incredibly risky.
It definitely takes a certain kind of trader to pull it off. You need nerves of steel, a keen eye for market sentiment, and a high tolerance for risk.
Definitely not for the faint of heart.
Not at all, but it's a fascinating strategy, and it can be incredibly rewarding if you have a knack for spotting those market turning points.
Speaking of turning points, what about this breakout trading I keep hearing about? Is that another one of those high-risk, high-reward strategies?
Breakout trading can be exciting. It really can. It's all about those aha moments when an asset just like surges past a resistance level.
Resistance level. So is that like a metaphorical feeling?
Exactly. Imagine a stock that's been bouncing between like $20 and $25 for weeks. That $25 mark, that's its resistance. Breakout traders look for a strong move above that, like a sign the price is ready to take off.
So you're trying to catch a rocket ship as it blasts off. Sounds exhilarating, but also a bit nerve-wracking.
It certainly gets the adrenaline pumping. And listen, it's not just about gut feeling. Breakout traders use technical analysis to increase their odds.
Ah, yes, the language of charts and indicators. I swear, every time I think I'm starting to grasp it, there's a whole new level of complexity.
I've been at this for years, and trust me, I'm still learning. But that's part of what makes it so fascinating. It's like solving a puzzle with real-world stakes.
Okay, so let's decode some of this. What are some of the key things day traders are looking for on these charts?
Chart patterns are a big one. And no, we're not talking constellations here. Though some traders might say they see those too after a long night.
So what kind of patterns are we talking about? Give me the trading version of connect the dots.
Well, one classic pattern is the head and shoulders, which can signal a reversal in the market's direction. It literally looks like a head with two shoulders on a chart. Then you've got triangles, flags, double bottoms. Each one tells a story about the battle between buyers and sellers.
So it's like these patterns reveal like the underlying psychology of the market?
Exactly. And then, of course, we have technical indicators. These are like mathematical formulas applied to price and volume data, helping us cut through the noise and spot potential opportunities.
It's amazing how much information you can glean from just a few lines on a chart.
Absolutely. Some popular indicators include moving averages, which we've already touched upon, but also the Relative Strength Index, or RSI.
RSI, that one always sounded kind of intimidating. Like, what is it really telling me?
It's actually pretty straightforward. RSI measures the momentum of price changes. Think of it like a car speedometer. If it's constantly hitting the red line, that engine's about to blow right. RSI above 70 often suggests the price is overbought and due for a pullback, while below 30 can mean it's oversold and might bounce back up.
So it's like a gauge for how much oomph is left in a price move, whether it's going up or down.
Exactly. Now, these are just a few examples. There are tons of indicators out there, and traders often use a combination to confirm their signals.
It's like having multiple tools in your trading toolkit. But even with all the right tools and strategies, Isn't the mental game just as important in day trading, if not more so?
You hit the nail on the head. You could have the world's most sophisticated trading system. But if you're driven by fear and greed, you're going to make emotional decisions. And that's a recipe for disaster in the markets.
Easier said than done, though, right? Especially when you're staring at a screen full of flashing numbers and your hard-earned money is on the line. Any tips for keeping a cool head in the heat of the moment?
One of the most powerful things you can do is develop a rock-solid trading plan. And I'm not talking about just like jotting down a few notes on a napkin. I mean a detailed plan that outlines everything, from your entry and exit points to your risk management rules. Think of it as your trading constitution, a set of unwavering principles to guide your actions, regardless of what the market throws your way.
So it's like having a script to follow, even when things get chaotic, which, let's be honest, they inevitably do in the market.
Precisely. It helps you remove emotion from the equation and make rational decisions even under pressure. And a crucial part of that plan is setting stop-loss orders. These are predetermined price points where you automatically exit a trade, limiting your potential losses.
Kind of like an emergency brake for your portfolio.
Exactly. Say you buy a stock at $10 and set your stop-loss at $9.50. If the price drops to $9.50, your order automatically sells, preventing a small loss from becoming a bigger one.
It's like that old adage, cut your losses short and let your winners run. But I imagine it takes discipline to actually stick to those stop-loss orders, especially when you're hoping a price will bounce back.
You're absolutely right. It does take discipline, which is why emotional control is so crucial in trading. One way to reinforce that discipline is by backtesting your strategies.
Backtesting. Is that like traveling back in time to see if your trades would have worked? Because if so, sign me up. I'd love to have a time machine for my investment decisions.
I wish it were that easy. But it essentially involves testing your strategy on historical data. You're basically simulating trades to see how your system would have performed in the past.
So it's like running your trading plan through a simulator to identify any weaknesses or blind spots.
Exactly. Backtesting helps you refine your approach, identify what works, and more importantly, what doesn't. And one more thing on the mental game. Remember to take breaks.
Wait, seriously? Step away from the screen. That sounds counterintuitive for a day trader.
Trust me on this one. Taking regular breaks, especially after a losing streak, can do wonders for your mindset and decision-making.
That makes sense. It's like clearing your head after a stressful meeting or hitting the reset button before tackling a challenging task.
Exactly. Give yourself time to cool down, reassess, and come back with a clear head. Now, even with a rock-solid plan and nerves of steel, it's crucial to remember that day trading is a constant learning process.
So even the pros are still hitting the books and refining their strategies.
Absolutely. The markets are constantly evolving, which means what worked yesterday might not work tomorrow. Tracking your trades, analyzing your wins and losses, and identifying patterns in your performance is crucial for long-term success. It's like reviewing game footage after a big match. You've got to learn from your mistakes and figure out what works best for you.
So it's not just about tracking the numbers, but also understanding the why behind your decisions.
Precisely. Keep detailed records of every trade, including your entry and exit points, your rationale for making the trade, and even your emotional state at the time.
So it's like having a trading journal, a record of your evolution as a trader.
I like that. A trading journal can be an incredibly powerful tool for growth. And speaking of growth, it's essential to remember that markets are constantly evolving. What worked yesterday might not work tomorrow.
So you got to stay adaptable like a chameleon, changing its colors to blend in.
Exactly. Be willing to adapt your strategy, experiment with new tools, and refine your approach as needed. The key is to stay curious, stay disciplined, and never stop learning.
So there you have it, your crash course in navigating the thrilling, sometimes terrifying world of day trading. It's not a get-rich-quick scheme, but with the right knowledge, a solid plan, and an unwavering commitment to risk management, you can set yourself up for success.
Couldn't have said it better myself. Remember, knowledge is power in this game. The more you understand the mechanics, the better equipped you'll be to navigate the ups and downs of the market.
Absolutely. And if this deep dive has ignited your passion for the world of finance, and you're hungry for more insights and strategies to level up your money game, hit that subscribe button and join us on Money Moves for more tips and tricks to make your money work as hard as you do. We'll see you in the next episode.